The wealthy have been using this strategy for decades, and many business owners don't understand how and when it fits into their situation. Corporately owned life insurance might be the most powerful tax-free wealth transfer tool available to Canadian business owners. In the next few minutes, you'll understand how the Capital Dividend Account works and why it's a secret sauce that makes corporate insurance so powerful. And you'll see a real case from a Toronto real estate developer who had $1.5 million in retained corporate earnings, a large projected estate tax liability, and no room left in his RSP. By implementing corporate-owned whole life insurance, he created a mechanism to flow over $2 million to his estate completely tax-free. My name is Quinton Chambers. I'm a financial planner and portfolio manager. I help Canadian business owners, incorporated professionals, and affluent families find financial peace of mind. And over the last decade of doing this work, one thing to me is clear. People just like you are leaving real money on the table. And on this channel, I show you where to look. Here's a problem that almost nobody talks about until it's too late. If you're a successful business owner and you've been profiting year over year, you've been accumulating retained earnings. That's real money sitting inside your corporation. Maybe it's 500,000, maybe it's 2 million, but you know intellectually, if you have no immediate plan for this money, you're gonna create an estate tax issue someday. You know that when you pass away, your estate is gonna have a big tax bill, and you know you should do something about it. Maybe you've maxed out your RSP, or maybe you just don't wanna pay yourself a dividend because you know that would trigger a huge personal tax bill right now. You tell yourself you're gonna figure it out later, but it never comes around. Here's your wake-up call. When you pass away, the CRA deems you to have sold off all of your capital properties at fair market value. This means your corporation shares are going to be deemed as sold, the gain is calculated, your estate receives a capital gains bill. Depending on the size of your gain and your province, that bill could easily be hundreds of thousands of dollars, maybe even millions. Your heirs are suddenly responsible for the tax bill, and if the business is being passed to your next generation, they now have to come up with the cash to pay the estate tax. And if that means the business has to be sold, the proceeds are going to be reduced by your estate tax bill. Either way, the tax liability erodes what your family will actually receive. Most business owners think, I'll deal with this when I retire, or my accountant will figure it out, or the business will sell and generate enough cash. Those are hopes, and as I said before, hope is the enemy of good tax planning. And here's what surprises most business owners. There's actually a mechanism to potentially completely eliminate that tax bill without selling your business or paying yourself out personally. The structure I'm talking about is corporately owned life insurance, typically whole life. Here's how it works. Your corporation buys a life insurance policy on your life, the owner. The corporation is the owner of the policy, and the corporation is the beneficiary of the death benefit. And each year, you're using corporate dollars to pay for the insurance premium. Now here's the important part. The corporation can't deduct the insurance premium as a business expense. That's a rule of the tax system. You pay the premium with after-tax corporate dollars. But, and this is a key, the policy grows inside the corporation tax sheltered. That means the cash value of the policy will actually accumulate over time without incurring any taxes. When you eventually pass away, the death benefit is paid to the corporation. And here's where the magic happens. The death benefit is not considered taxable income to the corporation. It's not subject to capital gains tax. It's received completely tax-free. Then your corporation will have the cash. The corporation shares will be eventually transferred to your heirs, but because this cash was a result of a death benefit and not of a capital asset, the portion of the share value is not subject to the deemed disposition and therefore capital gains tax. The way this flows is through the Capital Dividend Account, or the CDA. When a corporation receives a life insurance death benefit, the corporation adds that entire death benefit to the CDA. The CDA is essentially a tax-free account. Money in the CDA can be paid out to your shareholders, in this case your heirs, completely tax-free. It's like a tax-free pipeline straight from the insurance death benefit to your family's hands. Corporate-owned life insurance is not for everyone. It's specifically designed for business owners who have all of these characteristics. Significant retained earnings that they don't need personally, an RSP that's already maximized, and expected estate tax liability. If you only got $100,000 in retained earnings, you're planning to retire at 60 with a small pension, you probably don't need this. The scale doesn't justify the complexity. But if you're in your 40s or 50s with several $100,000 in corporate assets and you're projecting an estate tax bill in the hundreds of thousands of dollars, this is exactly what you need. The typical policy uses what's called a participating whole life insurance. That's different from your traditional term insurance. Term is cheap coverage for a limited amount of time. Whole life is permanent coverage that accumulates cash value. With participating whole life, you get annual dividends based on the insurance company's profitability and experience. Those dividends can be used to buy additional insurance, can be taken as cash, or be reinvested to the policy's cash value. Your corporation funds the policy, typically through regular annual premiums, the annual premiums with after-tax corporate dollars, and the policy grows tax sheltered. Over time, that cash value builds, and at your death, the benefit pays out tax-free and flows to your CDA. An extension to this strategy is if you're planning to do a family succession, and this can integrate with the overall estate plan. Working with your lawyer, you might also want to structure an estate freeze at the same time. The freeze locks in today's corporate value for tax purposes, and then future growth in the corporation is transferred to the next generation at a relatively low cost. The whole life insurance then provides liquidity for the estate tax and ensures the wealth transfer is structured tax efficiently. So let me give you a real world example. I had a client who was a real estate developer in Toronto. He was 52 years old. He'd built a successful company over 25 years. He had approximately $1.5 million in retained earnings in his corporation. He'd been very focused on building the business and hadn't paid a lot of attention to his personal wealth building. When I first met him, he asked me, what do I do about estate taxes? During his annual review, his accountant had flagged that his projected estate tax liability when he eventually passed was going to be in the range of $350,000 to $400,000. And obviously he was concerned. He created all of this wealth and the government was going to take hundreds of thousands of dollars from his family because of the capital gains tax bill at his death. Now, his first instinct was to take all the money out of his corporation as a dividend and try to move it outside of the corporation so it wouldn't be subject to taxes at death. But his accountant ran the numbers. If you took $1.5 million out as a corporate dividend, you'd trigger a massive tax bill, probably close to $600,000. He'd be left with only $900,000 outside of the corporation. That obviously didn't solve the problem, it made it worse. So here's what we did instead. We looked at his situation holistically. He maxed out his RSP room, he had no room there. He was profitable and had consistent cash flow, and he was healthy. He had a clear long-term vision to stay in the business for another 15 to 20 years. We implemented a corporately owned, participating whole life insurance policy. His corporation committed to funding the policy with approximately $150,000 over 5 years, or about $30,000 per year. This was structured as after-tax corporate dollars, meaning his cash flow took a small hit, but nothing dramatic. Policy was structured with a specific projected death benefit based on his age, health, and funding amount. The projection showed by age 70, the policy would have a death benefit of $2 to $2.2 million, depending on the insurance company's experience in dividends. Here's what that meant. He had a projected estate of $300,000 to $400,000. Now, when he eventually passed, the corporation would receive a tax-free benefit of roughly $2 million. That entire amount would flow through his CDA. His family would draw $2 million from the corporation completely tax-free, and that means the estate tax liability is completely eliminated. His family ends up with substantially more wealth than if he had done nothing at all. Over the 15 to 20 years of his projection, his corporation's cash flow is slightly reduced by about $30,000 annually, but that's an investment that returns $2 million tax-free. The return on investment is enormous. And that's the power of strategic corporate insurance planning. So if you're a business owner with several $100,000 in retained earnings, you've maximized your RSP room, and you're concerned about your estate taxes, this is a conversation you need to have. And especially because insurance premiums increase with age, this isn't something you should delay. The process involves working with 3 professionals: your accountant, who understands your corporate tax position, a life insurance specialist who can design the right policy, and ideally an estate planning lawyer who can coordinate everything so your overall estate plan and make sure that it is structured airtight. It's important to emphasize, do not try to do this alone. Don't try to do this with just your accountant or just an insurance broker. This is sophisticated enough where you should coordinate with your team of specialists. So if you're a business owner earning over $250,000 in your corporation, as always, please remember to like this video, and if you have any questions, leave them in the comments below. Also remember to subscribe so more videos just like this end up in your newsfeed. Until the next one, take care.